Hey friends, welcome back to the channel. If you are curious about the extended seller stamp duty and which SGX property stocks survive and thrive in this new landscape, this video is for you. I will provide 7 crucial insights. And watch till the end, because I will provide my personal take and strategy to making the lead position to this government regulation. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth right here in Singapore. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed the 1 million mark for number of reads and 58,000 likes. I've produced over 900 videos with more than 500,000 watch hours as of June 2025. I also focus on regional and global economic trends. If you're serious about taking your Singaporean investment journey to the next level, you'll want to hear this. Most Singapore investors think they understand the property cooling measures announced yesterday. But here's the shocking truth. While everyone's focused on the obvious impacts, there's a hidden investment opportunity unfolding right before our eyes. The government just extended seller stamp duty from 3 to 4 years, with rates jumping to a brutal 16%. But I've identified 7 crucial insights that will completely change how you view Singapore property stocks. These insights will directly impact your portfolio returns and wealth growth journey in Singapore. So let me break down the 7 game-changing insights that every smart Singapore investor needs to know right now. First insight: the real victims aren't who you think. Everyone assumes property developers will take the biggest hit, but here's what's really happening. PropNext, trading at SGD 1.10 with an 829 million market cap, faces the most existential threat. Their business model depends on transaction volumes. When the holding period extends to 4 years, it directly attacks their core revenue engine. They make money when properties change hands. Less transactions mean less commissions. It's that simple. But here's the twist. PropNext has built-in defenses most people miss. They dominate HDB resales, which aren't affected by SSD changes. Plus, their regional expansion reduces Singapore dependency. The market's panic creates opportunity for patient investors. Second insight: the fortress stocks that will survive. While property agents struggle, there's a category of stocks that actually benefits from these changes. Singapore REITs are the hidden winners here. When transaction-based investments become less attractive, yield-seeking capital flows to stable income streams. CapitaLand CICT trading at SGD 2.19 with a massive 15.95 billion market cap offers a 5% dividend yield. Think about it. When you can't flip properties easily, you look for steady income instead. Commercial REITs like CICT provide exactly that. They collect rent whether properties change hands or not. Mapletree Logistics Trust at SGD 1.9 offers an even juicier 6.8% dividend yield. These industrial REITs benefit from e-commerce growth trends that transcend any cooling measures. Smart money recognizes this opportunity. Third insight: the valuation disconnect creating opportunities. Here's where it gets really interesting. UOL Group at SGD 644 trades at a significant discount to its analyst target of SGD 7.72. That's nearly 20% upside potential. The market has overcorrected following the SSD announcement. UOL isn't just a property developer. They own Pan-Pacific hotels across Asia, Oceania, Europe, and North America. This diversification provides crucial protection that pure-play developers lack. When everyone's selling property stocks, quality companies get thrown out with the bathwater. City developments at SGD 533 show similar undervaluation. Their international operations spanning multiple countries provide natural hedging against Singapore-specific measures. These companies have weathered cooling measures before and emerged stronger. Fourth insight: the timeline strategy most investors miss. For even more detailed charts, deeper dives into the data, and a full written breakdown of today's topic, make sure to check out our Substack. The link is right there in the description. Now here's the strategic insight that separates professional investors from amateurs. This isn't about immediate gains. It's about positioning for the inevitable recovery. History shows cooling measures are temporary. Market fundamentals are permanent. Companies with strong balance sheets and diversified revenue streams will not only survive, but gain market share. When sentiment improves, these survivors will be rewarded disproportionately. The smart money accumulates during panic, not during euphoria. Fifth insight, the REITs rotation strategy. Singapore's 39 traded REITs with 82 billion in market cap present a compelling rotation opportunity. The SSD changes create several positive dynamics. First, reduced residential speculation drives capital toward yield-generating assets. Second, commercial REITs benefit from stable rental income, unaffected by transaction volumes. Industrial REITs like Mapletree Logistics. Trust captures secular growth trends. E-commerce expansion, supply chain modernization, data center demand. These drivers continue regardless of property cooling measures. Target 15 to 20% portfolio allocation to quality REITs during this transition. Sixth insight, the international hedge play. Hong Kong land holdings at SGD 620 with substantial international exposure provides an interesting hedge. While the stock appears insulated from Singapore residential measures, their MCL land subsidiary creates direct Singapore exposure. Reports suggest Hong Kong land is considering strategic options for MCL land. SSD pressures could accelerate divestiture at attractive valuations. The parent company's focus on commercial real estate aligns perfectly with post-SSD investment preferences. Seventh insight, the contrarian's roadmap. Here's your action plan. Immediate actions for the next 30 days. Reduce exposure to pure-play residential developers lacking diversification. Maintain positions in diversified developers with strong balance sheets. Increase allocation to commercial and industrial REITs yielding above 6%. Medium-term strategy involves accumulating quality developers on weakness below historical ranges. Focus on companies with significant non-residential revenue streams. Long-term opportunities emerge as SSD extension creates supply shortages. Companies surviving this transition with strong balance sheets will emerge with enhanced market share and pricing power. Iggy's personal take. After analyzing Singapore's property market for years, I believe this SSD change represents more than just another cooling measure. It's forcing a fundamental repricing of how we think about property investments in Singapore. My assessment: this creates a rare opportunity to accumulate quality assets at discounted valuations while avoiding value traps. The companies that will thrive are those with sustainable competitive advantages that transcend any single policy change. My direct advice for Singapore investors: don't avoid property stocks entirely. Instead, understand which companies have built resilient business models. Focus on diversified developers with strong balance sheets, quality REITs with stable tenants, and companies with international exposure. The key insight most investors miss is this isn't about timing the market perfectly. It's about understanding which businesses can adapt and which ones were riding a speculative wave that's now permanently receded. Patient capital will be rewarded when market sentiment normalizes. So, we've broken down Singapore's new property cooling measures, and I've given you my personal take on how it applies to your investment journey here in Singapore. If you found this video helpful and want to seriously level up your investing game, please give it a like, share it with your friends, and subscribe to the Investing Iguana channel so you don't miss our next insights. And for those who want to be truly ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else sees them. This means you get Iggy's detailed analyses and urgent insights on major market moves directly to your inbox, giving you a significant head start. It's just $1 a month, less than a cup of coffee. Think of it as your consistent daily dose of financial fuel for smarter decisions, delivered before the masses. Ready to join the inner circle and get that early edge? Just click the link in the description below to become a premium member today. Up next, I recommend watching my previous video on Singapore REIT investment strategies, where I break down how to build a defensive portfolio that generates steady income regardless of market conditions.